Good afternoon, everyone. Welcome to this quick session on dollar INR. Actually, it's not a very great afternoon because rupee has weakened to its all-time lows. The resistance region that we were following for dollar rupee between 87.50 to 87.95, you can look at this line. That region got broken today, and there has been a huge amount of dollar buying. There is very minimal RBI intervention, and the dollar exporters are very skeptical to sell dollars forward, and that is very easily understandable because both India and US are taking a hardline stance on the tariff that US has imposed on India, the 50% tariff that has been imposed. Okay, so both are not agreeing to a compromise, and it doesn't look like that the solution is anywhere close. So that is one of the reasons why the exporters are not selling forward dollars. So importers are buying heavily, RBI is not intervening, exporters are not selling. So there is a kind of price equilibrium, and obviously once the all-time lows, those kind of resistance region gets broken, there is a lot of stop losses that gets hit, and that too triggers the further movement. Okay, so rupee has declined to its all-time lows. It's around 88.20-25. So in such a situation, how should the exporters and importers hedge? Okay, so let's look at it one by one. Okay, so let me come to the importers first. They are in a slightly more precarious situation. I took a pricing at around 88.20. Okay, so in such a fire like situation, the most suitable hedging instrument is doing a vanilla option. Okay, and we know that by doing a vanilla option, you get unlimited benefit if market goes in your favor. Remember, this is in continuation to what I posted a week back, the video about doing vanilla options as well as doing seagull options. Okay, so now is the time to do options rather than focus on doing forwards. So an importer, what can he do? He can look at a vanilla option. The current spot is around 88.20, and you can look at doing a vanilla option for 1 month, and you can look at a strike price of around 88.31. This is the strike price equal to the forward rate, and you have to pay an option premium of around 45 paisa. Okay, now what happens is, it might look that 45 is a bit too high. Actually, it is not too high. Rupee has been weakening quite a bit, and the movement of 50-60 paisa, 40-50 paisa in a day is very usual. Here you are paying 45 paisa, a kind of a premium or insurance premium for an entire month. So the protection is there for one entire month. Okay, and what happens in this kind of an option? Your upside gets protected. You can have a look at this table here in detail, but effectively what happens is your upside gets protected. Here my strike price is 88.31 and a half, and I have paid around 45 paisa of premium. So what is my max rate? My max rate is 88.76 and a half. So whatever happens, irrespective of whether rupee goes to 89, 90, 91, your upside gets fixed at 88.7650, 76 half. No, okay, so that is there on the higher side. What happens if rupee recovers? The trade tensions reduces and rupee recovers. Now, if rupee recovers, you can get this entire benefit. Okay, you can get this entire benefit of the rupee recovery, and that is something that can become a very advantageous situation for you. Okay, so this is there for 1 month. What you can also do is you can look at doing for a 2 month as well. Okay, so this is a 2 month table. So if you look at a 2 month table, again spot is 88.20, the forward premium is around 25 paisa, so you get 88.45, and for 2 months you pay a premium of around 63 paisa. Okay, so what was 45 in 1 month, here you have 63 paisa. Again here the worst case rate or the highest rate goes to 88.45 plus 63, which is in excess of 89. But remember, it is a fire situation, the markets can go anywhere. So you get protected at a maximum level of 89, and if rupee recovers, the rupee gets stronger, you get the entire benefit of the rupee gaining. So this entire benefit comes to you. You don't get locked in like a forward rate, which is that red line here. Okay, if you do a forward at 88.45, you get fixed at 88.45, and irrespective whether rupee gains or rupee weakens, you get fixed at 88.45. And since the spot is at very high level, we have seen here the spot being so high. Let me get my chart again. If you look at this level, the spot is at dollar spot is at all time high. So at all time high levels, there is no much of a point of doing a forward and fixing your rate. The better thing to do is get a vanilla option and get that flexibility. Okay, but at the same time, you are protecting your maximum worst case rate. So very good instruments, globally very commonly used, and now is the time, I would suggest the most appropriate time to do vanilla options. Okay, so that is there for importers. What is there for exporters? You know, exporters are actually in a very comfortable situation because rupee has weakened and reached to its all time low. So they are getting more rupees for every dollar. It's quite a comfortable situation, but they are also very nervous because rupee has been weakening quite rapidly. You can see this chart, just about 1.5 2 months we were between 85 and 86, and in the end of August we are at 88 plus. So again, doing a forward becomes counterproductive. Okay, not very healthy to do a forward, because if rupee weakens again, then I will get stuck at a lower rate. So here again, for a dollar exporter, the best thing to look at is to do a vanilla option. Here you can do a put. Okay, you can do a put at the forward rate, the strike price of a forward rate. 88.20 is the spot. There is about 11-12 paisa forward premium. So you get strike price of 88.31. And again, similar to the call option, since it's an ATM option, the option premium will be around 45 paisa. So by paying 45 paisa, your minimum rate gets protected. Okay, so my strike price is 88.31 and a half, and I pay 45 paisa. So my minimum rate is 87.86. Okay, so this is that 87.86, the minimum rate. If rupee appreciates, then I get protected at 87.86, and if rupee weakens, I participate this entire weakening. Okay, that entire weakening I can participate. Unlike a forward is the red line. Okay, you get stuck up at one price, even though that price is also very attractive. But remember, 1 month back, if you would have done a forward, you would have got a lower rate. But if you would have done an options, you would have continuing to participate the rupee weakness. Okay, so in such a scenario, doing an option for an exporter also works very well. You can get the entire capture if rupee continues to weaken. Okay, now I want to show you for the 2 month as well. This was for the first month. This is for the second month. Okay, so for the second month, again 88.20, you have about 25 paisa forward premium. So you get 88.45 as your strike price, and for 2 months you have to pay a premium of 63 paisa. Okay, so remember, that is the insurance cost. And again, I would suggest 45 paisa for 1 month and 63 for 2 months is not very high. We are seeing a 40-50 paisa movement every day or every second day. Here again, you have a minimum rate, and that is 87.82, and if rupee continues to weaken like this, you get this participation. All these weak rupee levels, you work out better than the forward rate. Okay, so this is the time to do options. Since rupee is weakening like this, we never know where it is going to stop or where this trade war is going to stop. And as long as this geopolitical tensions continue, rupee might witness more volatility. Whether rupee will continue to weaken or it will recover, it is just anyone's guess. So in this kind of fire-like situation, vanilla options are the only hedging instruments that will become effective. Okay, so that's it from my side. If you want to get more such insights on market ideas, please join our WhatsApp community.